This is the ECOMFIN webinar series at the ESSEC Business School, and I am Andrea Roncoroni, Director of the Center. Today, we have Ferdinando Ametrano making a presentation on cryptocurrencies. Ferdinando is CEO of CheckSig, a startup providing Bitcoin and crypto solutions for private and institutional investors. And he is also founder and scientific director of the Digital Gold Institute at the Crypto Asset Lab. He has held courses on Bitcoin and cryptocurrencies in a variety of Italian universities, and currently he is teaching this course at the ESSEC Business School. He has been head of blockchain and virtual currencies in Intesa San Paolo Bank and member of the organizing committee of the Scaling Bitcoin Conference, and has occasionally and marginally contributed to the Bitcoin Core. His academic research work focuses on interest rate derivatives, but in the last few years, he switched to monetary engineering. So Ferdinando today is making a presentation on the cryptocurrency frontier of monetary engineering. Thanks for joining us, Ferdinando. The stage is yours.
Thank you, Andrea, for the kind invitation. Thank you, everybody, for attending this seminar and from in presence and remote. So, cryptocurrency frontier of monetary engineering. Let's see what I mean by that, okay? Okay, and this is currently, it worked until a minute ago, and no problem. I'm sure we will get it working. Let's make it this way. I will use this one. Okay, I use this one in the meantime, okay? Okay, so cryptocurrency frontier and monetary engineering. The key point is that we're living now in the information economy. Everything is digital, and the payment systems are really subpar compared to everything else. I mean, it's just moving data, and it is usually very inefficient with a lot of fees to be attached to any transaction. And well, I mean, Milton Friedman, he had this prophecy in 1999 about the one thing that's missing and that will be soon developed is reliable e-cash. Please note, a method whereby on the internet you can transfer funds from A to B without A knowing B or B knowing A. So this means this is cash. You don't have to identify the parties involved in the transaction. But before going into details, let me stop for a while and let's try to agree on what money is. I mean, according to Adam Smith, money is a social relation instrument. Human beings are born into a gift economy. My kids have not paid for the goods and services I provide to them. And I got, anyway, this is an economy because I got a reward. Surely not a monetary reward, a loving reward. But that is an economy also because I might have in the back of my mind the expectation that my children might take care of me when I get old or something like that. The gift economy does not scale. Because as soon as we reach relation, as we have relation with people we do not trust or we do not know, the gift economy is not suitable anymore, and we want an exchange economy. And first we had the barter economy, but barter, as people know, has a problem. The coincidence of wants. I may give you my eggs, you might want to give me back your milk, but the case must be that I want milk, that I want your milk, I want your milk now. So to disintermediate barter in time and space, we have invented the so-called trade economy based on money as medium of exchange. And this is really an extraordinary accomplishment of the human being because money is a synthetic asset invented to be able to cooperate and trade with people we do not know, with people we do not trust. And this is, if you ask me, amazing. So nowadays we live in a global information economy And so in a way, what we need is a supranational digital money. In the history of money, a lot of economic thinkers have been struggling to devise a money, to create a money that would have been able to provide stable prices. Yes, because recently, John Nash, he was writing and speaking about ideal money. And he made it clear, money should have the function of a standard of measurement, and thus that it should become comparable to the watt or the hour or the degree of temperature. So to have stable prices, since money, you know that money is the unit of measure, is the unit of account that we use to measure the value of everything else. So we want it to be stable. And ideal money, continue Nash, ideal money will be intrinsically free of inflationary decadence. What does he mean? Well, take a look at the US dollar. Since the establishment of the Federal Reserve in 1913, in the first century, the US dollar has lost 96% of its purchasing power. So it is very affected by inflationary decadence. You know, this is not the ideal money John Nash was dreaming about. And why is that? Well, I mean, inflation is planned to be mostly 2% per year, almost everywhere in the world. And you know, over 20 years, a planned inflation rate of 2% is basically a confiscation of 33% of the purchasing power of all savings. And symmetrically, the reduction of 33% of the value of all debts. So that's why it's not a surprise that the most debt-addicted economic agent, the nation state, does not like ideal inflation-free money at all. Okay? But another economic prize laureate, Friedrich Hayek, say that I don't believe we shall ever have a good money again before we take the thing out of the hands of government. That is, we can take them violently out of the hands of government. All we can do is by some sly roundabout way introduce something that they can stop. Yeah, you know, and since then, I mean, in the last 20 years of his life, Friedrich Hayek wrote Denationalization of Money, an essay that is very well worth reading these days. He made it clear that history of money is largely a history of inflation engineered by governments for their gain. But more than that, he was quite upset, I would say, that government monopoly of money is regarded as indispensable. And I mean, as every monopoly, it deprives public of the opportunity to discover and use a better, reliable money. And so, I mean, echoing a well-known sentence by Adam Smith, Friedrich Hayek said, "Blessed will be the day when it will no longer be from the benevolence of the government that we expect good money, but from the regard of the banks for their own interest." So he was dreaming about, you know, private money being issued by banks. But banks cannot do that, mostly because of central banks forbidding them from doing that. And so our only hope is the so-called permissionless innovation that we have seen with email, which have not been designed by a consortium of postal offices, or internet per se, which has not been designed by a consortium of telecommunications. And so probably a new network of money and value transfer will not be devised, will not be designed or proposed by banks. And here we have a candidate. Bitcoin clearly candidates itself as internet money, as the kind of money which has been seen or anticipated by Milton Friedman, as we have seen. But what makes Bitcoin special? Well, not the fact that it is digital or scriptural. I mean, euro and dollars are mostly digital and scriptural. Well, something more special about Bitcoin, it is the fact that it is an asset, not a liability. Okay, Bitcoin is nobody's promises. And moreover, Bitcoin is a bearer instrument. If you lose the private key controlling your Bitcoins are lost forever. There is nobody able to save them or rescue them for you. But the real, what makes Bitcoin really special is that it can be transferred but not duplicated. So for the first time in digital realm, we have something that cannot be duplicated. Or in technical jargon, it can be spent once, but it cannot be spent twice. It cannot be double spent. And so Bitcoin is, for the first time in history, scarce in the digital realm as nothing else before. It mimics gold monetary policy of decreasing incremental extraction. The quantity of Bitcoin being introduced is continuously decreasing, and so is marginally irrelevant in a way going forward. And so here it is, Bitcoin is, or at least wants to be, the digital equivalent of gold. Please note that we're talking about a kind of gold that has a secure, uncensorable, embedded settlement network. So a gold, which is really powerful and technically proficient in a way, okay? Bitcoin so is more a crypto commodity than a cryptocurrency. And this is the groundbreaking achievement by Satoshi Nakamoto, not the so-called blockchain technology. And if you're with me, well, I mean, if one considers the role of physical gold in distributed civilization, money, and finance, one can understand the digital equivalent of gold could be really disruptive in our current digital civilization and the future of money and finance. So Bitcoin wants to be the new global reserve asset. And well, I mean, I know a lot of people are skeptical, and I usually get some fun into inviting aliens that are agents with no previous prejudice about this conversation. And so I usually expect people from my audience to defend the traditional money, the so-called fiat money, while I will defend Bitcoin, okay? So in front of the alien, I will immediately say that that fiat money has no intrinsic value. People are usually quick to counter-argument that traditional money has a social contract, okay, a tender, and moreover, even Bitcoin has no intrinsic value at all. Okay, I might complain that I just explained that Bitcoin is the digital equivalent of gold, but whatever, let's make it even. Okay, let's start again. I will make the alien notice that regular people just wander around with paper money in their wallet. So the currency security of their money is based on paper and ink. Instead, the currency security of my money, Bitcoin, is based on math and cryptography. Moreover, in Frankfurt, Madame Lagarde can print as many of those paper money, as much of that paper money as she wants, wherever she wants. She can give them to whoever she wants. She has not been elected, and she will not be accountable for her role as a European Central Bank chairwoman, okay? Instead, Bitcoin is an algorithmic governance. And moreover, I mean, I expect today that we have a technical audience, so people might be aware that we had a negative interest rate unable to trigger the 2% inflation that was planned. And this day we have interest rate positive again, but inflation is completely out of control. As a matter of fact, we are seeing the end of the Winksellian interest rate approach from Winksell, the economist that made it clear for the first time that the monetary base could be governed by interest rate. Instead, Bitcoin, no interest rate, just deterministic supply. Last but not least, please let the alien aware that you are forcing myself to use euro with legal tender. I'm not forcing anybody to use Bitcoin. Bitcoin is just a free, non-binding choice. And I will leave it to exercise to the viewer and the listeners to figure out who the alien will be crazy, if me with my Bitcoin or you with your paper money. Jokes aside, people might point out that Bitcoin transactions are not taking off. Well, that's right. Bitcoin cannot manage more than 7 transactions per second. And even disregarding, because this is not the focus of today's speech, layer 2 solution, I mean, Bitcoin is already good enough to be a real-time gross settlement system. This is because Target 2, the ECB system for real-time gross settlement system, it manages about 100 million transactions per year. Bitcoin can manage 200 million transactions per year. So as you can see, Bitcoin is already perfect to be a real-time gross settlement system. And of course, this is not transactional money, but let's face it, whoever paid 10,000 Bitcoin for a couple of pizzas in 2010, that is $200 million at the current exchange rate, well, I mean, those were quite pricey pizza. And the problem with Bitcoin is that Bitcoin as money is not good money. Why is that? Well, money has to be a numeraire. We already said that. Money is the unit of account against which the value of every other good is measured. And the price system actually measures the value of goods relative to the value of money. And so good money should provide stable price. You remember the holy grail of the research that we have said in the first few slides. So good money should provide stable price to best perform its role as unit of account. Now, when it comes to Bitcoin, Bitcoin is amazing, incredible medium of exchange, probably the best medium of exchange we ever had. It's a very good store of value, provided that people correctly understand that store of value does not mean store of stable purchasing power. The stability of purchasing power in time has to do with the unit of account. And unit of account, well, those are the bad news for Bitcoin. Bitcoin is a very poor unit of account. This is because in March 2011, Bitcoin reached the parity with the US dollar. So $1 US, $1 Bitcoin. Well, 3 years later, whatever you were able to buy in March 2011 with $1, you were able to buy it with $1.06. But with Bitcoin, well, 1/500th of Bitcoin would have been enough. Okay, this is great news if you invested in Bitcoin, but this is dramatically terrible news if you have a mortgage denominated in Bitcoin, or if you pay the salary of your colleagues or employees in Bitcoin, or in general, if you have agreed on a forward price in Bitcoin. So successful at getting rid of a central monetary authority, Bitcoin has given up the flexibility of an elastic supply of money. So the supply of Bitcoin is completely inelastic. Completely inelastic. It does not adapt to change or shift in demand. And so, as a matter of fact, I already introduced Bitcoin as the digital equivalent of gold. So as gold has been used as money, and it has been adopted by every civilization without central planning. It has been the most successful form of money for centuries, but it has bootstrapped all monetary systems we know of. Anyway, it has been surpassed by other kinds of money without becoming obsolete. This is exactly what is happening to Bitcoin. Bitcoin has been adopted without central planning, can be used for money, is a poor kind of money, but it is bootstrapping new monetary system that will probably go ahead of Bitcoin. And this is what we are here to take a look together. So these first 20 minutes are kind of an introduction to the core of my talk. And the core of my talk starts from my paper, Hayek Money, in 2014. In that paper, I devised a cryptocurrency monetary standard of elastic, non-discretionary supply. So it is the price stability paradigm with respect to a given reference basket. Please keep in mind that when you talk about purchasing parity, purchasing power, you're always talking about purchasing parity with a given reference basket, okay? So As I told you, April 2011, Bitcoin dollars reached parity. 3 years later, it was $500. So let's assume that in those 3 years, sorry, without assumption, in those 3 years, Bitcoin, the demand for Bitcoin has increased 500 times compared to the demand of US dollar. Now, let's assume that instead of the 12.5 million Bitcoins in circulation in March 2014, I would have given the power to inflate Bitcoin arbitrarily. And I could have just made their number increase 500 times to about 6 billion, okay, and something. Now, on March 2014, it would have been completely equivalent to own one Bitcoin worth $500 or 500 rebased Bitcoin, each one worth $1. Okay, completely equivalent. Well, if I had been given that power of adapting the supply of Bitcoin, well, I could have been able, in those 3 years between 2011 and 2014, to continuously rebalance Bitcoin, the number of rebased Bitcoin, and adopting the USD Consumer Price Index. Well, of course, because rebasing to the US dollar will mean rebasing to the purchasing power of the US dollar. And so, okay, of course, you see, the exchange rate between my rebased Bitcoin and the US dollar would have been changing violently, but still it would have been anchored to the parity, okay, to an exchange at 1.0. Well, of course, after 3 years, 2% inflation per year, well, okay, I would have had the $1.06 equivalent, but whatever. So I would have been buying again into the USD Consumer Price Index. So I am anchoring my rebased Bitcoin to an inflationary monetary policy. Why should I do that? Let's try better. So let's try better and let's come up, just for the sake of an example, with a basket price including Brent and wheat, okay? And so you see the basket is the purple line comprised of the green one and the red one. And so the basket I devised in 2014 in my paper was a basket which was roughly worth $400, okay? And of course, denominated in Bitcoin would have been the blue line, okay? You will buy that basket with a fraction of Bitcoin after 3 years. But if my rebased Bitcoin would have been rebased continuously to achieve purchasing power with that basket, this would have been the exchange rate between rebased Bitcoin and that basket, or well, that would have been the price of the basket denominated in rebased Bitcoin. I put it at 10 rebased Bitcoin, and you see, that price is perfectly flat. Holy grail! This is stable prices. So rebasing the monetary amount in a very dynamic way, every day, you could achieve price stability. Well, close but no cigar. Close, because if I plot in this imaginary experiment that I did with a time series of Bitcoin, rebasing Bitcoin according to the recipe I've just told you, well, the volatility of USD rebased Bitcoin or the volatility of USD and Euro, well, pretty much the same scale. So I made a good money. I created a very good money. Rebasing Bitcoin, well, whoever is familiar with Bitcoin knows very well that you cannot do that. I was pretty naive at the time, but let me say that Bitcoin was just used for the sake of discussion, basically to leverage its historic price time series. Bitcoin is good as it is the digital equivalent of gold, more a crypto commodity than a cryptocurrency. Why do we want to tamper with it to make it a currency? Let's do better, okay? But before doing better, let's figure out what is the problem of this first simplistic implementation of IAC money, the one I proposed in my paper in 2014. Well, the good results are price stability, so salaries, mortgage, forward payments are possible, but first off, the number of coins in the wallet, they are rebased every day, so they changes without any real cash flows. So purchasing power of a given wallet is not stable. Let me make this clear, okay? Let's say that I have 100 Bitcoin in my wallet, and a TV set is worth 100 rebased Bitcoin. I go to the shop, but in the time I leave my apartment and arrive at the store, I open the wallet, and I see that now I don't have 100 rebased Bitcoin anymore. I have 99 rebased Bitcoin. Pretty unpleasant. And even if I have 101 Bitcoin, well, that is unpleasant too. Because you know what? That coins still have speculative investment. Because if Bitcoin is increasing in value, the number of rebased Bitcoin will increase in my wallet. And so I will have no incentive into spending them, and I will prefer to hoard them, to treasure them. And so those rebased Bitcoin will enjoy limited transaction usage. Okay, I will not use them to buy pizza because I'm afraid that spending them today to buy pizza will deprive me of the increasing number of Bitcoin or rebased Bitcoins I will get in the coming days. So you see, the early improvement and implementation to my idea have been proposed by Massimo Morini, but even better than that well, Massimo was the first one to figure out that we needed some kind of investment and saving asset. But Robert Sam was the first one to understand that what we need are two non-fungible different assets. He called them coins and shares. Well, actually called them coins and bonds, but I suggested him to call them shares, and he named them shares, even if he doesn't thank me in his paper. But he failed to clarify how to avoid exhausting one asset or the other in his inflationary-deflationary scenario receipt. And so, even early implementation of stable coin that have been inspired in a way by my paper were naive, wrong, or centralized, and consequently they all failed or faded into insignificance. Actually, the only one that have been successful at have been the stable coin like Tether, which are backed by US dollar. So as a matter of fact, what they're doing is having a cryptocurrency that is stable because it's backed by dollars, can be always exchanged at par with dollars. But you could do much better than that. So let me introduce you to dual asset ledger. So the implementation of IAC money performed with dual asset ledger. So we want to split transactional and speculative appeal of money using two different non-fungible assets. And we will use blockchain technology to track ownership and transaction for both of them. That's why we call it a dual asset ledger, okay? And we can imagine a reserve asset bank that might act as issuer, issuing both stable transactional coins and unstable speculative shares, okay? The market, of course, will attribute prices to shares. What is the monetary policy target? Well, we want the coin to be stable in purchasing power with respect to a given reference basket. Okay, so the coin is pegged to parity, and we want the coin to price at parity. That is, when we say that the coin has a value of 1, we mean that the coin can buy 1 unit of the reference basket, okay? We want the coin to be free to move in a corridor slowly below and slowly above 1. Make it as large as you like. Just for the sake of example, let's assume that the corridor is 0.95 and 1.05. There is no special meaning in having 5. We could have 0.99 and 1.01, and we might even have a non-symmetric corridor, whatever you like, okay? Anyway, the coins must be not inflated or deflated arbitrarily. So if the coin is worth 1 reference basket always, well, coins lose any speculative appeal. And this means that money velocity and transaction volume would increase according to the well-known MV equal PT equation. So what would that reserve asset bank doing? What are the market operations of that bank? Well, the bank needs reserve asset, let's call them a reserve asset, to enforce the coin price corridor, okay? So to enforce a floor, the reserve asset bank must be willing to always buy existing coin at 0.95 using its reserves, okay? And the bank must be willing to buy at 0.95 until reserves are completely depleted, okay? We are talking about deterministic approach. And to enforce a ceiling, well, the bank must be willing to mint coins, always willing to mint coins available for sale at 1.5. Okay, 1.5 what? Well, the coins will be sold at 1.5 in exchange for reserve asset that will be stored in the reserve asset bank. Okay, and willing to buy at 0.95, willing to always buy at 0.95, and willing to always sell at 1.05 will be pretty effective into enforcing a corridor, okay? So this enforcement, of course, should be algorithmically deterministic, not discretionary, okay? And how does it start? Well, let's imagine that we do an IPO for this reserve asset bank. We raise Bitcoins as reserve asset in a reserve asset quantity, and we issue with the reserve asset bank, coins and share in return. So of course it must be the case, the number of coins we issue, since those are liabilities for the bank is always willing to buy them at 0.95, the number of coins times 0.95 must be less than reserve asset, surely at the IPO time, but hopefully even at a later time, okay? Let's repeat that the market will independently assign prices to both the coins and the shares, okay? The monetary base of coins and shares is backed by the reserve asset. And so at equilibrium will always be true that the number of coins times the price of coins plus the number of shares plus the price of shares must be equal to reserve assets. Okay, is this clear? Let's move on. What are those seigniorage shares? Because we have clarified the role of coins being stable transactional money. What about seigniorage shares? Well, seigniorage, it's the profit made by a currency issuer, especially the difference between the face value of coins and notes and their production cost. Okay, so the idea is that the shareholders of the bank, they oversee the reference basket maintenance. Well, somebody must be in charge to figure out what is the reference basket. And that is only fair because in a way, it is their coin. They bake that coin with their capital. They put the reserve asset inside the bank and got the shares in return. So they are the reserve asset bank shareholders. They are entitled of the governance of this bank. The share price is, of course, free to float, and the share value, as with every company, is assets minus liability. And so you see that the price of a share is the residual, the reserve assets, so the asset, minus the liability, which are the number of coins times 0.95, divided the number of shares. And shareholder, in a way, they do absorb monetary policy profits and losses. They shield the coin holders from volatility. Why is that? Let's try to make it clearer. Let us assume that the coin price goes high, okay? And so reach the ceiling of 1.405. Well, this scenario generates profits for shareholders. Why is that the case? Easy. The ceiling enforcement is that newly minted coins are available for sale at 1.5. And so that increased reserves, so increase the reserve asset bank assets, okay? But because for every new minted coin, reserve assets increase by 1.05, liabilities increase by 0.95. So there is a positive net effect for shareholders. And so senior shares really enjoy seniorage revenues. They make money out of issuing new money. The opposite scenario, let's assume that the coin is not in demand. It loses value. It reaches 0.95. Well, of course, there are losses for shareholders because the floor enforcement is that to buy coin at 0.95, depleting the reserves. And so if the selling pressures does not stop, what will happen is, if the reserve asset are less than the liabilities, well, I mean, not all coins can be redeemed, so the coin is dead and the bank defaults, the share goes to zero. If the reserve asset, the asset are more than the liabilities, and the coin is not in demand, well, the coin is still dead, but the bank does not default, and so because there are residual assets in the bank, and so the price of the share is greater than zero. But in this scenario, there will be no interest at all for the stable coin, and shares are now strictly equivalent to the bitcoins they are entitled to. So this will mean that the world didn't like our coin and is just interested into bitcoins. So what we are devising right now is to leverage Bitcoin as a reserve asset, because Bitcoin is the first and most successful instance of an intrinsically scarce digital asset. It's digital gold. And when used as a reserve asset, its qualities are magnified. Its limits are lessened. There is no more need of scaling to huge number of transactions. There is no need to support economically inefficient micropayments. There is no need to lower the confirmation time. Let's remember that Bitcoin is a 10 minutes confirmation time. So the Reserve Asset Bank IPO will raise Bitcoin and issue senior shares and stable coins. This is bingo. This is actually the realization of another prophecy, this one by Finney in December 2010, when he clarified that the ultimate fate of Bitcoin would have been to serve as a reserve currency. One last step before closing up the speech. What about transaction validation? You might be aware of Bitcoin using proof of work, which is energy consuming, or proof of stake, or what I might be suggesting for this new monetary paradigm. Well, first off, keep in mind that the monetary idea I've illustrated so far is independent from the means used to validate transactions. But I think there is a smart way of validating transaction using the one I call proof of payment. That is, block generation is rewarded with the issuance of new shares, 1 share per block. Well, of course, we cannot issue coins if not for enforcing a ceiling. So it's not like we can use it to reward for block generation. So block generation must be rewarded by issuance of new shares. Instead of the hardware and electric power cost of the computational expensive proof of work, here I suggest to use Bitcoins in irrevocable payments made to the reserve asset bank by the validating network nodes. So the network nodes will send Bitcoins to reserve asset bank, claiming with that transaction a proof of payment. And the chances of a given node of being appointed for the next block generation are proportional to the overall submitted payments, that is, to their accumulated proof of payment. And when a network node is picked up for block generation, its proof of payment resets to 0, while the proof of payment of other nodes are not affected at all and are still valid for the next block. So proof of payment is relevant because if a node is not picked up for block generation, its payments are not lost or discarded. They are never reimbursed, that's for sure, never reimbursed, but they are still valid for the next block generation lottery. And since the price of a stock at equilibrium must be asset minus liability divided the number of stocks, that should be the maximum price a rational agent is willing to commit as payment in order to be rewarded with a new share for block validation, for block settlement. So share price, low bound estimation, is obtained as byproduct of the block generation lottery because nobody will commit more than the upper bound, and so the commitment of payments will be a lower bound in a way. So existing shareholders, please note that they are not really diluted. Okay, why is that? For the issuance of each new share, the number of the reserve asset held at bank premises increases accordingly. Actually, even more, considering that all proof of payments, cash flows, are immediately collected and then might be rewarded in the future. So I'm collecting the reserve asset bank, proof of payments for multiple agents, and I'm rewarding just one of them at a time with every block, okay? So there is a huge bibliography talking about these subjects, but the takeaways are price stability can be achieved with a new generation of cryptocurrencies, which I named IEC money. Multiple cryptocurrencies will be competing with different monetary policy definition, reference basket choices on dual asset ledgers that can be used to decouple speculative money from transactional money. Bitcoin payments can be used as economically expensive proof of payment instead of the computational expensive proof of work. And this is, in my opinion, the frontier of monetary engineering. Because, you know, it is about entrepreneurial monetary enterprise. Investors will risk their capital and they will gain only if the coin they are proposing is useful and successful. And this is all different from any kind of algorithmic stable coin that you might have heard, which just wish to create wealth out of nothing, but that is not feasible. Dual asset ledger fiduciary implementations are already possible, but a reliable technology for a decentralized automated implementation is probably not available yet. In both cases, Bitcoin as reserve asset can really bootstrap new monetary systems, and Bitcoin, the digital equivalent of gold, could be as relevant as physical gold for the history of civilization and the future of money and finance. And so we can imagine private monies competing with legal tender monies. If you think about how much it took to separate church from state, well, it will be as hard, if not harder, to separate money and state. But we are exactly at that moment in time where the separation of money and state is actually beginning. And so this is all for today. Thank you very much for your attention. I'm available for questions if you have any.
Thank you, Ferdinando. Actually, if there is any question there in the room, we may start from there and then we switch to online attendance.
No question from the room.
Just a quick question. Do you think that the development of quantum computing can undermine the stability of cryptocurrency system as it's been conceived and implemented so far?
Well, I mean, asymmetric cryptography, which is used by cryptocurrency, can be undermined by quantum computing. But asymmetric cryptography is used also by the traditional financial system. Moreover, it is used to secure the nuclear weapons. So quantum computing is a threat to all applications based on asymmetric cryptography. So as a matter of fact, cryptographers are already developing quantum-resistant asymmetric cryptography systems. So I only can see that in the future, when quantum computing will become a real threat, because it will require quite a few decades, people will just switch to quantum-resistant asymmetric cryptography. And when I mean people, I just don't mean Bitcoin and cryptocurrency, but I mean the traditional financial system and the security system of nuclear weapons.
Okay. And the second question is, how would you compare cryptocurrencies versus the idea you already talked about last time you presented in our webinar a few years ago, the one of this von Hayek currency based on a basket of commodities?
Well, I mean, key point is that Hayek would have not loved Bitcoin as money, because Hayek is all about having stable prices, and Bitcoin does not provide stable prices. And so at the beginning, I was fascinated by Bitcoin. I was fascinated by Hayek. My first proposal was to, in a way, let's say, rebase Bitcoin. But it was naive. The key point is that you have purchasing parity with a given basket, and people have been laughing at Hayek ideas of a basket of commodities. But the last few months made it clear that the basket of commodity is all relevant for economic planning and economic assessment. So I think that basically people will be playing with reference basket of including commodities. If I'm wrong about that, well, actually, if Hayek is wrong about that, well, people can have whatever basket they want. You can imagine a basket with 100 most sold items on Amazon. So you want the purchasing power compared to that. Or you might want the purchasing power to have a reference basket. Let's make an example like, let's assume that I have a stable coin with reference basket of 1 oil barrel. Okay. That would make Arab countries very happy. But if a green revolution, if a major breakthrough in sustainable energy will make oil obsolete, the price of the oil barrel will collapse, and the coin which is pegged to the oil barrel will collapse too. And what will that mean for that money? Well, that money will die. But that is evolutionary, physiologic, normal behavior. So it will be a market deciding what is best money. So to get back to the answer, I think that IEC suggestion makes a lot of sense. But even if it will not make sense, I mean, that is up to the monetary entrepreneurs to figure out what are the relevant or the sensible baskets to adopt for their money.
Okay, thank you. And now the difficult question. Any security whose range is between 18,000 and 24,000 euros per unit on a 4-month period would be considered quite volatile. However, for Bitcoin, this is a kind of synonym of stagnation. And this is actually the range in the last few months. Now, what's next, in your opinion? When next means in the next few weeks, months, and possibly years.
I don't have a crystal ball, as you might know. If I had it, I would use it to become rich. But I think that whatever Bitcoin might be doing in the next few years, personally, I think Bitcoin is here to stay. This digital scarcity, that is something relevant for all of us. So I expect that this kind of IEC money implementation or dual asset ledger, of course, will need to be more collateralized. Okay, a lot to take into account the volatility of Bitcoin compared to whatever reference basket. So let's say that an over collateralization 4-to-1, well, probably that might be enough. And so would require a huge investment from the entrepreneurs to launch such a new currency. But that is doable. That is doable. And as a matter of fact, as you see, even central bank digital, which are by definition stable coin, stable with respect to their own money. So one digital token issued by the Federal Reserve will be always worth $1. But again, $1 is inflationary. So we can do better than that. We can anchor our monetary policy to have zero inflation, according to what IEC and John Nash would have been advocating. Okay.
Okay, thank you very much. Is there any other question? Okay, so let me remind our participants that this webinar will be made available in a couple of weeks or so from now on our website. Thanks, Ferdinando, for this presentation, very insightful. And, you know, the next speaker will be Jerry Tsoukalas from Boston University and Wharton, still working on blockchain technology. Thanks to all the participants today.